Assalamualaikum and hi to Miss Sheila. Our group will present the impact of COVID-19 on US stock market. My name is Mimi Amira binti Osman and I'm going to talk about introduction, background of the study, statement of the research problem, objective and the significance of the study. So before that, we already know that this virus appears in Wuhan, in China, in December 2019, and in 11 March 2020, they already announced the name of the virus, which is SARS-CoV-2, which is Severe Acute Respiratory Syndrome Coronavirus 2, or we know it as COVID-19. Unfortunately, the virus spread very fast and almost every government around the world have closed down their country to avoid from the virus to spread in their people. Many events, many business, many activities that including crowd are restricted to prevent the virus from spreading. So because of that, this also affect the world economic activities. So the background of the study is, we know that the virus spread very fast and it can transmit very fast through only the sneeze or cough, and it easily can infect anyone who doesn't have the virus. We can see the effect of this pandemic from the significant fall of S&P 500 index from 31.32% to negative 12.77%. So we've made this study to investigate what is the relationship between these two, which is US stock market index price and the spread of the COVID-19. So the statement of our research problem is, what is the effect of COVID-19 on the US stock market? The objective of our study is we're going to study what is the relation between COVID-19 and the movement of the US stock market price. And we're also going to use two related factors to US stock market as components to investigate what is the relationship between the COVID-19 and the movement in US stock market. The significance of the study is, we know that there is effect of this coronavirus to the world economy. So this also affect the US stock market. And also this is the first paper to based on three financial metrics, which is volatility expectation, correlation expectation, and illiquidity. This study also an extension of analysis to other studies by using different kind of method to investigate the data on the different models. By studying the real reason of the changes in US stock market from the COVID-19, we can find the real correlation between these two, and we can come up with a few solutions to minimize the bad movement in US stock market.
Good day, madam. My name is Feng Yanpeng. I am from Group 12. I will present part 5 of our project, which is the literature review, which consists of empirical review and theoretical review. The empirical review is about existing idea or knowledge that found by researchers in their previous research on a certain topic. We can gain new idea or knowledge from carrying out empirical research on a certain topic. Previous researchers have used the Markov switching model to analyze data based on economic conditions like recession, high inflation, or high unemployment. It is used to introduce time variation in parameters in their state value. This can show the mean, variance, and other parameters are changing across regime, or also known as chapter. It is used in regression and autoregression. It is governed by the stochastic process. The current value state indicator is determined by the value of the state indicator from periods. This is an example of the Markov switching model, which there are two states here, the first state and the second state. For example, if it starts from the first state to remain on the first state, there's a 70% chance of this situation to happen. If it starts from the first state and go to the second state, there's only 10% probability of this situation to happen. If it starts from the second state and went to the first state, there's an 80% chance of this situation to happen. If it starts from the second state and stay in the second state, there's a 15 chance of this situation to happen. Next is the dynamic condition correlation gauge model, which is from conditional variance and correlation. It shows good value at risk forecasting performance for different portfolio. In this case is the US market stock. It is considered reliable and have flexibility of univariate gauge model with parsimonious parametric model for the correlation. It can also provide meaningful empirical result. Next is the theoretical review, which are issue, concept, or theory that we have already know from previous research. We investigate the existing theory on current research to develop new hypotheses. Stock market is where trading share of company take place, and the S&P 500 is market index used to measure stock performance of selected companies. Stock markets are usually unstable and experience volatility at different levels. And the current situation where the Covid-19 pandemic have affected the market performance adversely. Young and Liu expected the situation will cause a huge economic loss. This can be seen at previous similar event where Chen did a research on the SARS epidemic effect on stock market caused the performance to fall. It has a negative relationship with the stock return that are shown by an inverse relationship. And this is a graph shown by the empirical result of Just and Echoes. They did a research on the S&P 500 using three independent variables, which are volatility index, amplitude, illiquidity, implied correlation. And here we can see the S&P 500 dropped significantly during the second wave of the COVID-19 pandemic period. And during the drop, we can see the independent variable rise significantly. And this situation indicates where investors are rushing to sell their stock when the COVID-19 hit the stock market. And the next theoretical review is China and Japan are recognized as transmitter for spillover during the pandemic. Just and Echoes stated this happened probably due to the outbreak begin in Wuhan, which is in China. Japan also fall in the same position as transmitter. The fear of loss caused people to sell their stock and impact on the Shanghai stock market to plunge down. It spread across the globe, and the S&P 500 also fall. The panic caused most of the economy to collapse. This is the unique role of Italy in crisis transmission. After the COVID-19 spread across the globe, European countries are also affected as well. Italy is expected to influence an index return, while Just and Echoes did a research on 2020 that stated the nation debt figure have negative effect on S&P 500. And Italy is the first and hardest hit country in European that raised opinion of the country transmitting fear to other. And the fourth theoretical review is Markov switching model, which Hamilton on 1989 stated it is a commonly used model to study on stock return volatility forecast, and interest rate. It reports complex macroeconomic and financial time series as regime. And Turner on 1989 have used it before to assess the relationship between risk premium and stock return variance on S&P 500 return. And this is all for literature review. Next, we will look at the model specification of our research. Thank you.
Methodology 3.1 Model Specification. So in 1805, Legendre presented the first simple and descriptive exposition of least squares, and in 1809, Carl Friedrich Gauss he went beyond Legendre in least square method because he invented the normal distribution and he successfully relates least square approach to probability and normal distribution. Then later on 1822, Gauss developed an optimal least square approach to regression analysis in the sense that the best linear unbiased coefficient estimator is the least square estimator in a linear model where the errors have a zero mean, are uncorrelated, and have similar variance. So in model estimation, we need to find out whether there's a non-linear relationship between two different variables, which independent variable x in the horizontal axis and random variable y in the vertical axis. So based on the graph, to determine the baseline fits the data, we square the errors and a line that minimizes the sum of the square errors, as shown in the linear regression. And then this method will help us find the value of the intercept and slope coefficient that minimize the sum of the squared errors. And first of all, there's the simple linear regression, and when you expand it with more independent variable, it becomes a multiple regression model. So next, in estimation strategy, I use SP500 as an index for our study to relate with the volatility index and the COVID cases, or we use it in infection rate, an error term, and the intercept. So to determine this is used to determine the relationship between the COVID-19 disease with the US stock market index movement. So we will use all the data and run the evil, compute it, so we will get a result and we can relate it and analyze by using this simple least square method. So if the coefficient is positive correlation, so means the COVID-19, an increase in COVID cases will lead to an increase in SP50 index, 500 index. Yeah. So next for 3.4 data description, all the data were sourced from different websites. So first of all, the stock market index and volatility index were collected from Yahoo Finance database, and the COVID cases were collected from Worldometer statistics. These data consist a range of 254 observation of a year from 2019 to 2020. And that's all. Thank you.
Hello everyone, my name is Taekyang, and my camera is a bit blurry and I don't know why, and I guess it's a bit too late to fix it, so I'm just gonna continue with my part with this camera. So my part is the empirical finding. First, descriptive statistics. The data is not normally distributed based on the analysis and p-value reject the null hypothesis. The Jekyll value is high, which indicate the errors are not equally distributed. And the second is multiple regression. Based on the computed multiple regression using eView, we can say that the independence and dependence variable have a negative relationship. When independence variable increase will cause the dependence variable to decrease. Heteroscedasticity. There is no heteroscedasticity as the p-value is larger than significant level, so the data is homoscedastic. Autocorrelation. The test has been conducted using Turpin-Watson stat and show the result where the model exits autocorrelation problem. Similar results shown by the LM test where the p-value is less than 0.05 lead to rejecting the null hypothesis, which means autocorrelation exists. Multicollinearity. Multicollinearity does not exist in the model proved by the variation inflation factors test where the values is less than 10. That's all about my part, so thank you.
Hi, my name is Umar Zakwan, metric number BG19110362. In conclusion, this study aims to investigate the relationship between the explanatory variables and response variable during the COVID-19 pandemic. The explanatory variables is the volatility index and the dependent variables are stock returns. The summary of this study is to investigate the relationship between the variables during the COVID-19 pandemic period. The independent variables were tested against the dependent variables by using regression analysis. Policy and implications are the fiscal policies were introduced as a relief package. For an example, the US funding bills were introduced to help ease the burden, which includes the unemployment benefits, direct stimulus payments to individuals, testing and tracing costs. Secondly, students' loan payment relief. These policies is introduced to the students' education during the pandemic period. And third is the enforced act that prepare and provide supplement to aid medic aid in the development of vaccines. Lastly, the limitations and suggestions. The limitations in the studies are the inaccurate regression analysis. The data must be selected according to the suitable situation and able to explain the dependent variables. Thank you.